Hi everyone, Melvin here. I've been having texts and requests to do more videos. I'd want to say for the record that I did not stop. I never planned on stopping. I just took a little bit of a break for personal reasons to get better at this and also like dealing with other stuff. So I can say I'm back. I literally want to scream the whole back thing, but we're here. So just like we said, we're going to be saying things on this channel. We're going to be teaching things that literally don't have much grounding on the internet. So in today's concept, we're going to talk about the fair value gap. That's just the way most people know it. So I'm not going to bring up a new definition. I'm not going to bring up a new term. Whoever wants to take credit for the term fair value gap should take it. But I'm going to explain, according to my knowledge, according to my understanding of the markets, what we're supposed to be looking for in the fair value gap, because mostly what I see on the internet is there's a gap in price, and within that area you can take an entry within that area. Yes, it's not as simple as that, but that's the whole concept of this video, so we can try our best to dissect what the fair value gap means. So with the fair value gap, all I can say in the beginning, like right here for anyone to understand, is it's a gap that is created in price due to volume. So right there, anytime an imbalance area is created, we mostly have volume playing in the market. There's no liquidity. So anytime a candle traces back into an imbalance area, that's where we're building up the liquidity. So with the two lines you're seeing on my charts, there's nothing more to it than just a marking up of liquidity that someone will call or most people will call the fair value gap. So with the fair value gap, we're going to have two areas to the fair value gap. Let me take this off and redraw it so people will understand how this came about. So with the fair value gap, we're always going to have two areas. Anytime we have an imbalance area being created, it's going to leave a gap, but that gap is where to denote that gap, and how to react to the gap is what most traders are finding a bit difficult. So let's talk about it. The first candle that prints into the imbalance area after it has been formed is going to be one area that we're going to take note of, and then the wick or candle. Usually when we don't have a wick, we're going to get the base of the candle that created the imbalance, but mostly we have a wick. So we're going to denote two areas: the first wick that prints into the candle, and then the wick that was there before the imbalance candle was formed. So let's take a look at the first area I denoted on my chart. So this is right here. So I'd like to say these are not my concepts, I'm also learning, but these are the way I have come to understand the fair value gap. These are what works for me. I find it too cliche on the internet that you just look into a gap and you're willing to take an entry from any space like within the gap. You could have a huge gap, you could have a small gap, literally like affects your risk to reward ratio. And I don't feel like if any trader should have like random risk to rewards, like you should have something that you're willing to risk every single time. So based off of that, you can decide whether this entry is worth it for me or not. So we're going to have two areas in the fair value gap: the area that prints into the gap, and then the one that was there before. So anytime we have this candle, this particular one that printed into the imbalance area after it was formed, this is going to be our first level of the fair value gap, and this is going to be a previous level of the fair value gap. So with this, I like to use the first level of the gap for entries, because like I said, this whole imbalance area is volume. So once a candle prints into the fair value gap, this area is our liquidity area. Yes, so before the famous question, what time frame do you do this on? What time? You can do this on any single time frame. And just trying to know that if you're going to get entries based off of this area, it's better to do it on maybe a slightly higher time frame, so that you can drop down and get your entries with structure on the lower time frames. Let's say I like to do this above the 1 hour, with 1 hour and above, literally. So here, this candle printed into this area, and this candle is like our liquidity benchmark. So once this candle tells us where our liquidity is, or where our liquidity footprint is, once there's a closure above this candle, so this is what I was saying, that I'm going to explain the fair value gap so that we know like how we're going to be in a trade. We're literally dissecting the whole area of the fair value gap. So once we have a candle close above this area, it means this liquidity point has been breached, and then we have to go for the next point. So with the fair value gap, the first candle that prints into it, this is sell side fair value gap. So with the first candle that prints into it, that's where we're going to like to take our entries, the top of this wick, because that's where most of the liquidity is at. So anytime we have price close above this point, it means that price wants to go for the liquidity right here. So let's say with this we decide to drop down for an entry, would go on the lower time frames. We have to see how price reacts to this point. Once there's a break of structure, or however you like to call it, once there's a structure shift in your direction to the sells, you know that that area has been fulfilled, and then price wants to move in your direction for the sells. So anytime price closes, not a wick, not a purge, anytime price closes above this point, you should know that my fair value gap sells are not going to hold. We're going to literally see price move to this point before price decides to melt or continue to the upside based off of structure. So that is one example. Let's see if we can find other examples on the charts to show. So right here was an imbalance area, and I think here I'd have a little bit to say. So right here was an imbalance area, but we can clearly see with this that market opened with a gap to the upside. Anytime market opens with a gap to either the upside or the downside, I don't know if anyone has said this, but anytime market opens with a gap to the upside or to the downside, usually price is going to follow that price action for majority of the week that's following. So usually at market open we have a huge gap to the upside like this. Literally means that price is going to keep trending to the upside. So in this case, the whole gap area is considered an imbalance area. So we're still above the first point where price breached. So right here we're still above it, price gap to the upside. So this whole area is more like an entry point. This is the first wick that printed right into this area. So once price does not print below it, we know that our buys are going to hold. And if we had a price closure right beneath this point, a candle closure right beneath this point, whichever time frame you draw your fair value gap on, I cannot stress this much enough, stay on that time frame, because literally a wick on that time frame is going to look like it's going to be a body on another time frame. You're going to be complicating things for yourself. You're going to always have mixed feelings if you see like a candle body into your area. Just stay on the time frame, so a body will be a body and a wick will be a wick. That gives you more indication. Do not drop down. When you're dropping down, you're literally finding entries, but do not let a candle closure on a lower time frame, which will be a wick on your time frame where you found your gap, deter you from taking the trade. So let's go to find more examples and see. So like right here, there was an imbalance area to the upside. The first wick that printed into the imbalance was right here, and then where in this case where we don't have a wick that printed into the imbalance area, that was in the imbalance area before, we can get the base of the imbalance area, that was right here. But here we have a wick, so we're going to pick this wick, and literally this is going to be our fair value gap. So with this, you see how the first wick that printed into set the liquidity print point. So right here, this is like a liquidity benchmark. So when price wicked into this zone, wicked right here again, this is, you can always take your entries at this point. You just drop down on a lower time frame, see how structure is reacting to the point, and then take your entries. I'm sure most of you you're hearing me saying drop down to a lower time frame. I teach how to react to structure in subsequent videos, but I also feel like most of you that will watch these videos are good traders on your own. You know what to do with the markets, and there'll be a complete structure session in the next section of videos. So this is it. If price prints into your liquidity benchmark here and price does not close, you see why I cannot stress much on staying within the same time frame that you found your gap on. If price does not close beneath this point, there's no candle closes right here. There are no candle closes beneath this point. Shows you that price is not ready to come for this level right yet. So over here, 1 wick which did not print into your area, your entries are not ready yet. Once this wick prints into your area, you can always take your entries. Find your stops according to structure on the lower time frames, but these are always your entries. So once we have a candle closure beneath this point, your buys are done. Literally know that price wants to make it to this point. So in this area we have our entry right here. We're going to, so we have our entry right here, and then we're going to target above this point. With entries and targets too, would do that in a subsequent video. In this video, I literally want you to understand the fair value gap with your entry patterns or whatever it is you've been using before. I just want you to understand what the fair value gap does. So that's it for a buy side. Let's see. So with this, once we had these closures beneath this area, we see how price had to come to this area and then close it out. Now we know that once these section of bodies closed beneath this, buys were done for this point. Price had to make it to this liquidity area. So that's it with the fair value gap. Right here, another beautiful example. So we had the candle that printed into the imbalance area when the imbalance area was formed. We have the candle that was right there before. We never saw price close above this area. Price never closed above this area. More indications that we are into ourselves. So right here, price melted as expected, and it was a go. Same thing here, an imbalance area to this downside. Perfect. So we had price print into our liquidity benchmark. Price did not close above it. More sells. So it's always like that. It's always going to be like that, and it gives you like more insight as to what area I'm at, whether price is going to keep buying or keep selling depending on the gap I'm in. No. So let's see another area. Okay, right here. Once again, I don't want to even say it. We had our benchmark, price failed to print above our benchmark, price kept selling. So it's literally like the footprint of liquidity, where most of the liquidity is after an imbalance area is formed. We don't always have a 50% retracement into an imbalance area right at once. On the higher time frames, you can see where price is making the liquidity, where price wants to grab liquidity from, and that's all. So usually when price prints above this point, then we'll go for this whole liquidity range, create liquidity in that range, and then decide to push to the downside or the upside. But mostly when your liquidity benchmark has been traded into or closed above, then we're going to come for this point. That's the whole point of the fair value gap. So once your liquidity benchmark is closed above, we know that okay, our sales ain't ready yet for this particular move, so price is going to come and print into this area. I don't want to keep this video so long. I hope that most of you have gotten like a fair understanding of the fair value gap. This is not going to be, the fair value gap has a whole lot of things to talk about. This is like one of the first basic concepts that you need to know about the fair value gap. So thank you very much for sticking into the end of this video. Like I promised, I'll be back with more content. I'll always be here with something that, what I say, has never been talked about before, but something that will give you more insight to your trading journeys. Oh yeah, and I forgot to do the most famous part. Don't forget to like, don't forget to subscribe, refer this video to a friend who's interested in trading. I'll see you in the next. Thank you.